Without so much as a hint of warning, China stunned the global energy market with a seismic announcement. It would halt all imports of liquefied natural gas, LNG, from the United States. The news was jarring. There was no prior notice, no gradual escalation, just a sudden cold response to US tariffs. The market scrambled to understand the implications of this aggressive move, and one thing became abundantly clear. This was far more than a routine trade dispute. This was a carefully calculated maneuver in a high-stakes geopolitical and economic game. At first glance, it seemed like just another chapter in the bitter trade war between the US and China. But a closer look revealed something much deeper. Beijing framed the decision as a counterattack in retaliation for the 10% tariff the US had imposed on Chinese goods back in February 2025. However, this action had far-reaching consequences, not just for the United States, but for global energy markets and supply chains. In an instant, the economic landscape shifted. Chinese buyers, faced with the daunting new tariffs, wasted no time in rerouting LNG shipments that had originally been scheduled to go to East Asia. Instead, they turned these shipments toward Europe, bypassing the tariffs altogether and taking full advantage of Europe's growing need for energy. In doing so, they also managed to grab a significant portion of the European market share, further solidifying China's position as an energy powerhouse. This bold maneuver had reverberations far beyond the energy sector, with the US left grappling with lost market share and an uncertain future in the LNG market. Europe, as if caught in a whirlwind of geopolitical turbulence, found itself as the unexpected beneficiary of this LNG shuffle. While the US was effectively sanctioned out of the picture, Europe gained access to cheaper LNG from the very source it had once feared losing out on. In the midst of this global energy crisis, the US was sidelined, while Europe grew ever more dependent on LNG from non-American sources. This was no ordinary market shift. It was a dramatic reversal that illustrated just how fragile the global energy landscape had become. But this was only the beginning. March 2025 saw another shocking announcement that left the US even more exposed. Australia, a country long seen as a minor player in the LNG game, moved swiftly to fill the vacuum left by the United States' fall from grace. Woodside Energy, one of Australia's largest energy companies, had secured a groundbreaking 15-year agreement with China Resources Gas, a key Chinese energy company. The deal stipulated that, beginning in 2027, Woodside would supply 600,000 tons of LNG per year to China, solidifying Australia's position as one of China's primary energy suppliers. The scale and timing of the agreement sent shockwaves through the industry. Australia, once a distant rival to the US, had now emerged as a formidable challenger in the race for global LNG market share. What made this deal even more striking was the timing. Not only was it a significant economic win for Australia, but it also came at a crucial juncture for China. By 2027, the China-Russia East Line natural gas pipeline would be fully operational, offering China an alternative, cheaper source of natural gas through pipeline deliveries. The Woodside Agreement, therefore, not only marked a victory for Australia, but was also part of China's larger, long-term strategy to diversify its energy supply and reduce its dependence on a single source. The price point was compelling. Australian LNG was 20% cheaper than US LNG, and its transportation time was shorter by 10 days, giving Australia a clear competitive advantage. The question that echoed through boardrooms and government halls around the world was simple yet profound. Why would China, an adversary in the global trade wars, choose Australia, a key US ally, as a major LNG supplier? Why would China open its doors so widely to a country that was historically aligned with the United States? The answer, however, was far from straightforward. To understand China's rationale, one must look beyond the immediate trade war dynamics and consider the broader picture of energy security. China, with its massive population of 1.44 billion people and its position as the world's second-largest economy, has become an energy juggernaut. With an energy consumption rate that is unmatched in scale, China's demand for natural gas has skyrocketed in recent years. By 2024, China had imported a staggering 132 million tons of natural gas, worth over $63 billion. LNG had become a key pillar of China's energy strategy, accounting for 58.1% of total natural gas imports. The US had long been one of the largest suppliers of LNG to China, with vast natural gas reserves and an expanding export market. By 2024, the United States had surpassed Qatar and Australia to become the world's largest LNG exporter, shipping out 91.2 million tons of LNG globally. But as the US pursued a more aggressive trade agenda under the Trump administration, China saw an opportunity to alter the balance of power in its favor. When the Trump administration imposed a 25% tariff on Chinese goods in 2019, China retaliated by slapping a similar tariff on US LNG, choking off one of the most important energy export markets for the United States. At first, the US LNG industry took a hit, with exports to China plummeting. But by 2020, the trade relationship slowly began to recover. However, the damage had already been done. The tariffs increased the cost of US LNG by 23%, and by 2024, the United States accounted for only 5.4% of China's LNG imports. The US, which had once dominated the LNG trade, found itself facing fierce competition from countries like Australia, Qatar, and Russia. And then came the hammer blow in early 2025. China suspended its LNG imports from the US entirely. The decision was seen as a direct response to the ongoing US-China trade tensions and was a striking demonstration of the fragility of global trade relationships. For the United States, this wasn't just a loss in the energy market, it was a massive financial blow. Each year, the US had been exporting approximately 400,000 tons of LNG to China, worth roughly $2.4 billion. Now that market was effectively gone, and with it, the US faced a critical revenue shortfall. For China, the impact was minimal. With a range of alternative suppliers, Australia, Qatar, Russia, and Central Asia, China was well positioned to weather the storm. The diversification of its energy sources had been a deliberate strategy over the years, and now it was paying off. Even with the loss of US LNG, China's energy security was intact, and its role as a major player in the global energy market was only growing stronger. Meanwhile, the US LNG industry found itself in a precarious position. Backlogs of unsold LNG shipments piled up in ports across the country, costing US companies millions of dollars every day. The once thriving industry, which had been touted as a pillar of US economic strength, was now in free fall, unable to secure the contracts it so desperately needed. But just as the US faced its darkest hour, Australia seized the moment. The deal with Woodside Energy was a bold move that not only secured Australia's energy future, but also positioned it as China's preferred LNG partner for the next 15 years. This agreement would see Woodside supply China with 600,000 tons of LNG per year, starting in 2027. The long-term nature of the deal further solidified Australia's place in China's energy future. What made this deal even more striking was the geopolitical context. Australia, an ally of the United States, had managed to secure a key energy deal with China at the expense of the US. This wasn't just a business deal, it was a statement. Australia had positioned itself as a key player in the Asian energy market, gaining favor with one of the world's most influential economies, while taking full advantage of the US trade war fallout. As the years progressed, the dynamics of the global LNG market continued to shift. By 2027, when the Woodside deal would come to fruition, China's LNG imports from the United States were expected to be a distant memory. China had already strengthened its energy ties with Russia, Central Asia, and Australia, while also ramping up domestic production. The US, meanwhile, would be left to confront the reality of its dwindling market share in the LNG sector. In this new energy landscape, the US would have to rethink its approach to global trade and energy diplomacy. The days when it could use LNG as a tool of political leverage were over. China, having diversified its sources of natural gas, was now in control of its energy future. The US, on the other hand, was left scrambling to find a way back into the market it had once dominated. This dramatic shift was a stark reminder that the energy game had changed. The world had moved on, and those who had once been at the helm, like the United States, were now struggling to keep pace with the new geopolitical realities. To stay informed and continue following this unfolding global energy saga, make sure you subscribe to our channel and turn on notifications. The stakes have never been higher, and we'll continue to provide you with the latest insights and updates on this complex and dynamic issue.